Hello and welcome to Rebank. I'm your host, Will Beeson. Mark Garabedian is the Director of Digital Assets and Tokenization at Wellington, a leading US-based global asset manager with approximately $1.3 trillion in AUM. Mark has wide-ranging experience in trading and financial markets and brings a highly informed perspective to the topic of financial market innovation through digital assets and blockchain. I find Mark's views to be particularly valuable because they skew heavily toward the practical as opposed to the theoretical, informed as they are by decades of hands-on markets experience. In this conversation, Mark and I discuss the transformational benefits of digital assets and tokenization in investments and markets, step function improvements DeFi has delivered and the implications for traditional finance, the specific projects Mark and Wellington are working on today, the path that Wellington, a nearly 100-year-old asset manager, has taken so far on its digital asset journey, and much more. Thank you very much for joining us today. Please welcome Mark Garabedian. Mark Garabedian, welcome to Rebank.
Thank you. Place to be here.
Very happy to have this conversation. I think it's been a long time coming. You and I have known each other for a while now and had the great pleasure of working together to kind of take a step back from the day-to-day and have more of a zoomed out conversation on where we are in the broader on-chain finance transition, your work in leading digital assets at Wellington, amazingly storied, large US asset manager, and just kind of open it up and explore and see where your head is and where the opportunities that you're most excited about in this space currently sit. So thanks for making the time.
No, thanks for having me, and I'm really looking forward to the conversation. And, you said it. It's been a pleasure working with you over the years here, and it's fun to be able to sit down and do this.
Awesome. So great. Maybe to kick off, it'd be cool to get a little perspective on your vision of this world. I mean, you're a finance guy. You've spent multiple decades now working in markets. Tell us a bit about your background and how you got to the role that you're in today.
Sure, happy to. I spent the first 2 decades of my career in trading, and I have traded everything, every which way, all across the globe. I was a prop trader. I was a market maker. I was on the buy side. I've traded equities. I've traded futures, fixed income, FX, commodities. I traded developed markets. I've traded emerging markets. I traded the US region time zone, European region time zone, and the Asian time zone, doing the overnight shift here in the US. So literally all across the globe. The last decade of that I spent in trading research. I was at MFS for a number of years, building out the trading research platform there, and came to Wellington in 2019 to build out a trading research platform there. Trading research is market structure, market microstructure, execution optimization, algo optimization. And to synthesize all that down, it's being a market plumber. It's understanding how orders are created, sent through the system, make it onto the various different exchanges and venues that they can be traded at, how price discovery is achieved, how the clearing and settlement process is done, feeding all the downstream ancillary systems, creating data, and then utilizing that data for future analytics to improve the process. It was great. I honestly loved trading, and I still have a big passion for it. So that's the first start of how I got into this space, was through trading. I had a very close friend that I grew up with, and he was a big online poker gambler, and he played a lot of online poker. And one day the platform that he had used approached him and said, look, we cut you a check. And if you want us to continue cutting you a check, it takes us like a month to get the check to you, and we charge you all of these crazy fees. But if you want, we can give you payouts in Bitcoin and you'll get that money instantly. He said, what is this Bitcoin thing? Can I sell it for dollars? They said, sure, here's an exchange over here. If you want, you can send it there and you can trade it in for dollars. And he said, fine, pay me out the Bitcoin. Faster, cheaper, sounds good. And like many people who went down that path, he stockpiled the Bitcoins in his account because he could use those to place future wagers. And he became, like an overnight millionaire. And so he dug down into the space and, started getting into all of the various niches of crypto. And knowing that I'm in trading and in financial markets, he started nudging me. And so right around 2020, he's like, man, this is a space you've really got to start paying attention to. This is something that's right up your alley. And so I started diving in myself. It was right around DeFi summer in 2020. And my first foray into the space was using a Coinbase account, like just about anybody else. And there's probably 100 assets on Coinbase at the time. I was using their regular retail account. I wasn't really all that impressed. It was like you send an order into a black box and you get a price back and you get your fill. And then I noticed that they had an advanced trader, a pro platform. So I moved over to the pro platform and my jaw hit the floor the first time. What I experienced was bid offer spreads, price discovery, brokers, algorithms, assets trading, liquidity, volatility, volume, sophisticated price charts. And I sort of said to myself, if you were to take the traditional exchanges and destroy them and build them from scratch again, it kind of would look like Coinbase. Like it was very sophisticated, seamless. You could do things on your phone. It was all very user friendly. So I became pretty enamored with it. And as a trader, I don't really need to know what the asset is. I can, trade off of charts and sentiment, things like that. But I did start digging into the assets themselves because I'm like, what are these things that I'm trading? They're all cryptocurrencies, 100 of them here. They can't all be the same thing as Bitcoin. There's got to be more to it, to this than that. So I started going down the rabbit hole. I started learning more and more. The second aha moment for me was I had said to my friend, everybody on crypto Twitter is talking about this Polkadot. I'd love to buy some Polkadot, but it's not listed on Coinbase. How do I get to buy some Polkadot? Like, is there another exchange that I can use or, anything like that? He said, well, you got to go to Uniswap. I said, let's Uniswap. And so he came over to my house and we pulled up a website for Uniswap. And I did the wallet connect. My wallet was on my phone. So I did the wallet connect from my phone to the website. And I swapped Ethereum from my wallet to Polkadot. And again, my jaw hit the floor. And I was like, that's amazing. And he turned to me and he was like, what? It's just Uniswap. And I said, you don't understand. I just experienced no counterparty risk, no credit risk, no settlement risk, and an instant increase in the velocity of my money. Those are no-brainers for my industry. Like everybody would love to be able to take advantage of that. I need to dig in and find out how this Uniswap really works. So I started digging in and understanding the AMM protocol, understanding on-chain finance, and understanding how blockchains work, and started using Aave. And at the same time, I was raising a bit of rancor within the firm, within the trading department. People need to see this technology. It's incredible. I wasn't alone. There was a number of us at the firm who were doing that. And so in the fourth quarter of 21, the firm put together a working group and they called us Digital Disruption. There was 15 of us. We were cross-functional and global. And we were tasked with canvassing the space far and wide and figuring out what was real and what was impactful to our industry, put it together in a report, deliver it. So we did that. We created an 85-page research report. We delivered it to the CEO and her leadership team. That was where I had the third jaw-dropping moment. During that research, I started to dig into stablecoins and understanding tokenization and understanding that stablecoins are basically money market funds that are unregulated and don't pay interest at the time. And that we could tokenize our own funds and you would get all sorts of distribution gains from that and efficiencies throughout processes. And so when we approached to deliver the research report, rather than coming with this focus of, hey, here's this thing called Bitcoin, and it facilitates anonymous peer-to-peer transfers of value, it's trustless, and you don't need intermediaries, which is really interesting and definitely impactful. But for an investment firm, is there necessarily a huge business opportunity? Instead, we approach it from the perspective of tokenization. And you could tokenize anything, and you can instantly increase its velocity and broaden distribution, gain efficiencies, and you can tokenize funds. That's bread and butter to our business, and that resonated, and people understood it. And it was a small leap there to say, if you believe in blockchains and you believe in tokenization, it's got to live on a blockchain, and that blockchain is probably going to be Ethereum or now Solana or Avalanche, any one of the major ones. And that's why those have value. And so that summer we got green lighted and I was asked to take on the lead of the initiative. And so I transitioned into the role in October of 2022 and have been at it since.
Perfect timing to take on the role, I guess.
So to your point, I was there For a good 3 weeks, I had the wind at my back. Even though the bull market was slowing down and there were some gyrations, people were still pretty positive on the future and the path. And then the news about Sam Bankman-Fried stealing the entire world's money dropped. And all of a sudden, the brakes were hit. Crypto became a dirty word across the entire industry. And I went from playing offense to playing defense and having to explain how FTX and the debacle there had nothing to do with blockchains, nothing to do with blockchain technology. The assets themselves were secure, that fraud could be perpetuated anywhere. And this was a case of fraud. But certainly it set back the entire initiative pretty healthily, and it's taken a while to get back on track. So that was really tough timing for sure.
Yeah. How would you characterize the energy, the interest level at Wellington and potentially a proxy for the broader incumbent financial industry? Firstly, it sounds like you really focused on the right areas at the very beginning. This 2021 research you were doing was directly tied to the business and the interests of the business and the places where TradFi and crypto blockchain intersect in ways that I think are very interesting and will be transformative over decades. From there, like tracing through then FTX and everything post, and now even into the new presidential administration, the crypto friendliness, potentially over friendliness of the current administration. How would you characterize the energy, the feeling, the thought process within the firm over that period of time?
I'm going to start off by saying the strength of a firm like Wellington is that we have a broad diversity of opinions and perspectives, and they're all very informed. And that is where we draw our strength from. So you do not have to go far to find alternative opinions. In my opinion, this was a no-brainer from the start, but not everybody shared that, right? And I come in as, you asked me about my background. I come in as a market player. And so, I understand those downstream processes and integrations and how this could create so much efficiency in the space and really has very broad applications. Others come in from the perspective of analysts and portfolio managers and technologists and operations folks, and they know their day-to-day experience, and they know the hurdles that this technology would have to go through in order to be integrated into the broader financial ecosystem. And they know of the incumbents that would fight along the way to maintain their positions. So I think when I first embarked onto the role, when I first took on the role, I had more naysayers than supporters, for sure. And, I guess I would classify the world into three buckets. It was the biggest bucket where I don't know enough about it. I'd like to learn more and I don't have an opinion. The other two buckets would be, I know all about this and I'm supportive. I know all about this and I don't think it's a thing. I think it's a fad, or I think it's not going to work, or it's not up to snuff. And a big part of my role was to seek out those alternative opinions, the ones that differed from mine, and have conversations and learn from them and understand, like, what am I missing? If you say something that I didn't know and is a valid argument against this technology, I need to go get educated on whether you're right or if there's counter arguments to what you're saying. And, sometimes there weren't counter arguments. A big one is cybersecurity. Like, I think we're all pretty resolved that in an on-chain world, the value of cybersecurity goes up dramatically. Like, that's just a fact. That's not going to change. The value of cybersecurity and the risk of breaches and hacks and stuff like that goes up. It's an internet-based economy. And so that's part and parcel. Not that that's insurmountable, but that's something that we all have to become accustomed to. I would say today that bucket of people who don't know and just want to learn more has shrunk considerably. And a big part of that is just the outreach that I've done with help from numerous people throughout the firm. In general, has been very supportive. Even the naysayers are very supportive of giving airtime and hearing me out and understanding, the perspective that I'm coming from. Again, that's our value at Wellington. We all seek out those different perspectives and hold those different perspectives and don't try to all swim the same way in the pool. So I would say that broad bucket has shrunk considerably, and I would say the naysayers have shrunk considerably. And that's not to say that they're not, but I would say the naysayers have shrunk considerably. And a big part of all of it is there's been a decent amount of people who were naysayers that said, Well, with this current administration and the amount of support that they're giving to it and the impending regulations that seem to be on the table and look set to come live this year and the other jurisdictions, and also the fact that it's got staying power. I mean, we've been through some serious debacles in blockchain technology and crypto assets and had Bitcoin sitting at right just under 100,000. And so that staying power also helped convince. I like to describe the prior administration as one that had their foot on the brakes for the technology and the industry as hard as they possibly could. You can offer plenty of different reasons for, why that was happening. Perhaps it was to protect incumbents or to give incumbents more time to catch up with the technology. Perhaps it was consumer protections and just fear about consumer protections. And perhaps it was just a lack of education and needing to get up to speed themselves, but it's pretty obvious that the foot was on the brake as hard as it possibly could. I characterize the current administration as having taken their foot off the brake and pushed their foot on the gas pedal as hard as they possibly could. And so this year has definitely been a lot of meaningful progress and a lot of momentum moving forward.
Yeah. I know that you're very plugged into your peers at other firms as well. You're really part of the dialogue. Do you think that your experience and the sort of trajectory at Wellington is representative of peer companies? Is everyone looking at this in a similar way, do you think?
I would say they're almost moving in waves. There are some peers of ours who are definitely out ahead. They've been at it for longer, they've done more, and frankly, they just have bigger teams going at it. I'm not, saying anything that hasn't been made obvious publicly, but I can think of BlackRock, Franklin Templeton, and Fidelity as three who have done just a tremendous amount moving forward. Then there's, I think, the next sort of cohort. And actually, in that first cohort, I should also throw out Hamilton Lane. Hamilton Lane has done a lot as well. And so, just speaking more from the alternative side, and to a degree Apollo. Then there's that next cohort, which is I would call fast followers, people who are definitely engaged and making meaningful contributions, just not to the same degree as the peers who are leading the way. We're in that cohort, and there's a few others alongside of us that are also in that cohort. And then there's a tremendous amount that, as far as I know, just do not even have a strategy, do not have anybody dedicated to this, and still haven't really caught up to speed. I imagine that's going to change throughout 2025, but we'll see.
I'd love to get into some of the specific projects to the extent you can talk about them that you've worked on, are working on. But maybe before drilling into that level of detail, just blocking out where you see the opportunity sets for TradFi in this space, certainly in the context of Wellington, but also just other parts of incumbent financial services. You mentioned some of the reasons that you thought tokenization was beneficial to an asset manager. Can you provide any more color on some of the specific reasons? Is it you touched on distribution, you touched on cost efficiency? What are the highest value, most immediate drivers, you think, of some of the adoption?
I'm a big analogy guy, and so I'm going to use analogies wherever I can. And the analogy I'm going to use here is to the first wave of the internet, because this current wave, it really is just a new wave of the internet and is very, very similar. In the first wave of the internet, companies realized that they could sell their products over a web page. And that helped them dramatically increase distribution and created efficiencies by basically taking orders over the internet, but selling their products and offering their services over the internet. In the early goings, the general consensus around the internet was like, oh, it's just for drugs and porn, and no one's really going to use it. No one would ever feel comfortable putting their credentials into websites. Pioneers made progress, made steps forward. Upstarts came into the fray and created new business models that were entirely online, selling products such as Amazon, and it began to spread. So in this wave, instead of selling your products through a website, you're selling your products through tokens. For our industry, you're using tokens to distribute your products. The advantage is, again, it's distribution. So you're just able to hit a much wider audience, and you could do that much more efficiently. So I'll get a little bit specific about that. In the first instance, we did a proof of concept with Citi, and I'm happy to talk more about it. But it was in partnership with Citi, Avalanche, Wisdom Tree, and TTCC. The white paper was published in February of 2024, and it was really well received. But what we showcased there was we simulated tokenizing a private equity fund and using the tokens to onward distribute from one custodial platform to another custodial platform, something in the alternative space that is fairly difficult, almost impossible to do today, but extremely difficult and costly to do today. And we did it instantly. We did it with digital identity and an onboarding framework. Certainly, the regulations, particularly at the time, weren't fully robust enough for that to have been a live experiment, but we showcased that that's where the hurdle was, and it's not in the technology. The technology has a use case, has a product market fit, and can be used for that purpose. So, again, it's broadening distribution, it's creating streamlining as well. Another use case that I've read about from a lot of research reports and we've done some exploration on, there are markets in Southeast Asia that are smaller countries, and it's very difficult to offer financial services within those countries in a commingled vehicle because jurisdictionally you have to launch the vehicle within that jurisdiction to comply with the regulations for that jurisdiction. There's a cost embedded there, and it can't necessarily raise enough assets to be able to cover the costs for deploying that vehicle directly into the jurisdiction. Tokens allow the ability to embed the token with compliance controls such that when it goes into a jurisdiction, it's already enabled for the compliance controls within that jurisdiction. So it allows you to have one vehicle that can be multi-jurisdictional very seamlessly and again, cost effectively. So you can start picking up assets in all of these multiple jurisdictions and have economies of scale so that you're able to offer financial services, in a cost effective manner. So again, broadening distribution, being able to put the products into the hands of more people, democratizing access, alternative products today. It's very difficult for people who are in not even just the retail space, but the mass affluent space. It's very difficult to be able to access those products because of the high minimums that are around them, the onboarding process, the ability to get accounts and maintenance. And so, again, tokenization unlocks opportunities to be able to distribute products through there. We're still in a world where tokenization is probably going to sit alongside paper books and records. And so some of the cost is more additive today than it would be. But in a world where you don't have to necessarily have those paper books and records, there certainly would be a lot more cost efficiencies. There's downstream cost efficiencies too that have yet to be realized around NAV distribution and data aggregation, things like that with all assets or with any asset that sits on a blockchain. So really, it's a lot about products. That's on our product side, basically like what the output is. On the raw materials side, so if you talk about tokenizing equities, tokenizing fixed income, tokenizing any of the types of assets, even FX, again, considerable gains that can be made just through efficiencies. If for nothing else, when you speed up settlement times, then you are able to increase the velocity of money. You're able to get the money reinvested faster, and you're able to increase the rate of return. So that's an efficiency. Being able to take manual bespoke processes and create API-driven, technology-driven, code-driven processes, having products that have, again, compliance controls enabled within the token itself. All of those things are over time deflationary impact on costs.
On that cost point, I've heard incumbent asset managers talk about how impactful or sizable fee compression has been on the product side over the past number of decades, I guess, at this point. I don't know what the fee structure you used to be able to charge on a mutual fund is, but now we just kind of assume that 5 basis points is the default fee structure on any vanilla product. And can you go up to 20, 30, 40 for some sort of exotic product? But the cost structure has not changed meaningfully over an extended period of time. And if anything, potentially it's even gotten higher. Is there truth to that? Do fund managers, asset managers view this as a sort of cost optimization play to try to win back some margin that may have been compressed out of the system over the past years or decades?
Anytime you're upgrading the system, I mean, you could just, again, think about the first wave of the internet. So I could sell my products over a web page. The alternative was having multiple brick and mortar stores strewn out all across my distribution zone. Obviously, having the brick and mortar stores was a more expensive path to distribution. And so the internet does just allow you to have more efficiencies and more scale. So, to your point about cost increases, the biggest cost increase, I'm going to say that this is my opinion, because I obviously can't peer into everyone's books, but in my experience, and particularly when I was in trading research and had a foothold into this, one of, if not the biggest cost driver has been data. And there's so many parts of the business where you need to have data, and you need data to be integrated. And the process for getting your hands on clean and accurate and reliable data is expensive. You have data vendors who are selling it to you that have all of the pricing power around that data. You have to have a whole team that manages multiple ingestions from various different data feeds. You have to curate all of that data into one data model within your walls. You have to propagate that data out to multiple different downstream systems in order to be able to action on that data. And then once you action on that data, you create new data, and you've got to feed it right back through the systems. It's a very cumbersome and costly experience. The biggest beauty about blockchains is that all of the assets and all of the information sit in one underlying curated database, and it's API driven database. So it's very easy to be able to access that information. We worked on a proof of concept with a number of partners in the space, but it was led by Chainlink. And again, the results for the first phase were published, and people can look up those results online. And again, this is one that got a lot of buzz in the industry and a lot of feedback. It's geeky and it's nuanced. And so the general person isn't going to be like, wow, that's a home run. But it was Project Calm. And the idea was that everybody in the industry houses their own security master, which is your representation of all of the assets that you own and trade, within the world, and all of the metadata around those assets and the issuers of those assets. And it's cumbersome and it's big and it costs a lot to be able to maintain it. And it's different than everybody that you interact with and their versions of data. And a large portion of the reconciliation processes that we have and the time that it takes to settle stuff, it's basically I go to market and I say, hey, I bought this and this is what it looks like and this is what I know about it. And my broker says, oh, I think I know the same thing, but this is what I call it. And this is how it looks like. And then the exchange says, sure, we trade that, but this is what we call it. And this is what we think it looks like. And then the other side that's trading against us says, I know that one too, but this is what I think it's called. And you have, all of these different parties that have to reconcile against each other. If I want to trade Ethereum against your will, I can just point to Etherscan and say, hey, here's Ether right here. This is what I'm trading. These are all of the details about it. And you could be like, yeah, that's the exact same Ethereum and all the same things that I know about it too. And so we don't really have to reconcile. And that's at the end of the day why blockchains are able to move so fast, blockchain-based assets. Project Calm was just this idea of, can we separate the value transfer from the data management? And so rather than using the blockchains to move the ownership of the assets, can we use blockchains to store all of the issuer and issuance metadata of the assets, all the publicly available information, and weave through corporate actions? That's why it's called COM, Corporate Action Lifecycle Management. Weave through the corporate actions into these assets to have an industry utility, updated database, accessible to everyone, API driven, where we're all pointing at the same asset and understanding the same information, all in the same underlying data model. I think that the first phase was a success, and look forward to working with Chainlink on future phases for that as well.
One thing we haven't touched on yet is the payments side of it. You had mentioned stablecoins and some of your interest in stablecoins in how you got into the role that you're in now. I guess I'd be curious, any projects you've worked on or specific examples that you see as particularly relevant, worth highlighting in the stablecoin and or payments space?
Yeah, absolutely. So I'll give you my thesis on all of this just to lay the landscape. The original wave of getting into crypto for the broad public is Bitcoin. Bitcoin is a very distinct and unique asset. I don't have to tell your audience. I'm sure they're very familiar with Bitcoin, but it's a very distinct and unique asset, digital gold. millennial gold. It's got all sorts of monikers. It's a diversifier. It's for wealth preservation. It's got 24/7 liquidity and transferability. It has its own value proposition. It has a killer use case. The next wave of adoption that comes in with crypto assets is through stablecoins. The value proposition for stablecoins, the way that I explain it to people, is when you're in the United States, you have a Venmo account. You're very familiar with sending money back and forth to other people who have Venmo very cheaply. It's basically free, very seamlessly and easily. If you ever tried to Venmo somebody in Japan, you can't do it because Venmo is not offered, outside of the country, and it would have to go through a network of correspondent banks. So I describe Venmo as first of all a blockchain based system anyway, like a private blockchain based system. They manage everybody within that system, and they're just moving the assets around. And stable coins would be like taking Venmo, offering it as global payments, keeping it still extremely cheap, being able to increase the efficiency of payments. I think that it appears that the administration and Congress are going to be set to pass legislation this summer that will codify regulations around the issuance and maintenance of stablecoins and stablecoin reserves. And that will be the impetus for stablecoins to be integrated more into the broad financial payments ecosystem. Recent announcements from both Visa and MasterCard of enabling the capability for people to make payments in stablecoins and have Visa or MasterCard solve the last mile at the vendor is a great example of that integration that needs to be done. I think there are other jurisdictions that already have regulations in place for stablecoins, but since stablecoins are all US dollar denominated, I think it's almost 100% of them right now, like 99% of the total AUM is dollar denominated. We need US regulations in order to drive that forward. And so you will have faster, cheaper payments that can be made, feel just like using a Venmo. It really won't feel any different, at least with the technology and the providers that I've seen. And that will spur a lot of adoption for the broad general public. Stablecoin volumes grow. And with the growth in stablecoin volumes, network activity grows. When network activity grows, the fee generated from that network activity grows. And then you'll see valuations in the rest of the crypto asset ecosystem start to grow along with it. And I think that's where you get potentially the next phase of the bull. So stablecoins, they are on the horizon. I think once those bills are signed, we're going to see a bit of a Cambrian explosion. We partnered with an issuer out of Singapore. Their name is FundBridge. And, our goal together with our client FundBridge, and there's a third party partner in there, Libera, who is the tokenization platform, blockchain integration partner. So, and the three of us together, our goal is to be able to try and capture some share of the growth in that stablecoin market, along with just the growth in on-chain finance and the movement of assets. And so, similar to what BlackRock has done through their product Biddle, what Franklin Templeton has done through their product Benji, we have these vehicles that sit on chain. They're money fund vehicles that can be used for stablecoin reserves. And it allows for an upstart stablecoin issuer to be able to park their assets in a regulatorily compliant way based on, how the US regulations are written and the rest of the global regulations are written. They can park their assets within that vehicle. It's a commingled vehicle, but it's got name brand institutions on it, and they're able to basically give confidence in the holders of their stable coins that the assets are securely held. The vehicles sit on chain, so you can point to where the assets are sitting. You have proof of reserves, and it gives some credibility to the whole process. So I think that's going to be a big market to be able to play in. There's a lot of research that's being written right now. It's a potential strategic priority for the United States because stablecoins generally hold treasury assets, and we have a lot of treasury bills that are earmarked for deployment over the next several years. There needs to be a marginal buyer. There's less buyers internationally from foreign governments. Stablecoins could be that marginal buyer. And so it seems like the stars are aligning for a very good, again, Cambrian explosion in stablecoin issuers and stablecoin activity, and a need for trusted parties to offer vehicles that clients can park their assets in. That's kind of the value proposition that we're seeing right now in stablecoins. broadening that out to, to those reserve vehicles, they can also be used within traditional finance as well. And so just last week, the DTCC in the United States did their great collateral experiment. It was live streamed. In my opinion, it was a great success, but they showcased how tokenized money funds can be used to provide as collateral for margin trading within traditional finance ecosystems. And so that's just another area where the two worlds start to collide.
Yeah. Yeah. Wow. As geeky as it sounds, very excited about that specific space that you're talking about, creating on-chain, in a sense, risk-free assets, reserve assets that can play the role that bank grade, core tier 1, tier 2 equity, HQLAs, play in a TradFi world. And if you then combine that with 24/7 instant settlement and all the efficiencies that you mentioned, plus the ability to automate financial flows on top of smart contracts, then I think it's potentially extremely transformational of ultimately one of the biggest, maybe the biggest market in the world, the U.S. Treasuries market / repo market. Working on something there myself, which would be great to share more about at some point. Maybe on the collateral management piece, can you say more there? What was the thesis that project was intended to prove out? And then I'm also aware of some work done to basically study whether tokenized assets could be used for collateral in traditional financial use cases. And it sounded like some of the recommendations ended up being the form, structural form, whether tokenized or dematerialized, shouldn't actually have much of a bearing on the validity of certain assets being used as collateral.
So I'm going to wind back to the first statement that you were talking about, because I'm not sure that this is totally understood by enough people. When I took on the role, the title that I was offered was Director of Digital Assets. And I said, I would like this to be the Director of Digital Assets and Tokenization. I said, wow, that's a lot of words. It's going to be really long. And I said, but tokenization really is the key here. And I don't know if everybody can see what I'm about to do, but when I say it's like the size of the total crypto assets, it's like the size of my palm. And you've got Bitcoin in there, and you've got, other crypto assets and stuff like that. And when you talk about the total potential size of tokenized assets, I can't spread my arms wide enough. It's literally everything that has the potential to be tokenized. Tokenization really is what this is all about. And when we're talking about collateral and we're talking about payments and stuff like that, we are definitely going at the biggest slice of all of that money and all of that value transfer. So again, when we talk about on-chain finance, it's increasing the velocity of money, it's reducing credit risk, reducing settlement risk, and reducing counterparty risk. Those are huge when you're talking about collateral. So again, like when I first experienced these things, it wasn't just about going and trading something, but even when I was using Aave for the first time, as a platform, it blew my mind. It was crazy because here I could instantly pledge an asset, take a borrow off of it, have that money in my wallet in a matter of seconds to get from start to finish. And then I could turn around and unwind that position just as quickly and turn around and pledge new assets in. So, yeah, I mean, obviously, that whole process has largely sat outside the regulatory perimeter. And there's a lot more, like you said, with title transfers and whatnot that needs to be codified. The technology works. That's the most important. That's the most difficult part for us to solve for is the technology. The technology works. What we're describing here, to me, sounds like when Uber first came out, hitchhiking was still illegal. And when you ordered an Uber, you were hitchhiking. And it basically operated outside of the regulatory perimeter. And there were a lot of legal battles that happened with Uber, and it took time before it was matured and then brought within the regulatory sphere. And so now, when you step into an Uber, the driver's had a background check, and everything's being tracked and reported and stuff like that. And many places throughout the world, Uber is safer than a taxi cab. Who would have ever thought that when Uber first hit the scene? That's kind of where we are with this space. We're in that process of doing the background checks on the drivers and creating the regulations that need to be put in place to take advantage of the technological change in a safe and prudent manner that will allow for those efficiencies to be experienced.
Yeah. Yeah. Maybe actually as just a quick service to the listeners here, like the words collateral management, or thrown around a lot, especially in the context of tokenized assets, usually by people who I think don't have direct experience with institutional collateral flows and use cases. Can you just describe for us, why is collateral such a big deal? Why is there so much collateral? What are the specific example use cases where collateral is in the flow in large volumes? And then what's the tangible outcome of the opportunity to manage collateral in a better way?
I actually think your listeners might understand it better than we're giving them credit for here, because I imagine they use perp exchanges. I imagine they've used Aave before. And so I imagine that they just understand capital efficiency and levered returns. And that's really what it is. So you're providing collateral in order to be able to trade on margin, trade on leverage, to have more capital efficiency and to improve your return profile. It's a very popular thing to do within hedge funds, but it's sort of like, if I want to take a position in the futures market betting on a move in interest rates, and I want that position to be 100 million in exposure, do I really want to be putting $100 million out there on the line? That's not very capital efficient. It would soak up a bunch of the balance sheet of the strategy that's doing it. It's much better if I can just pledge an amount of collateral that would cover for any major changes in price differentials for the assets that the strategy is being deployed into, and I can take the rest of the money and go deploy it elsewhere or go earn yield on it or whatever. So it's all about capital efficiency and being able to increase returns through leverage. Big part of the business, big part of the industry, but it's difficult. So again, talking about that DTCC experiment and a number of the other projects that we've been a part of and worked on, can talk about Canton Network and a lot of the great work that they have done around the same sort of area, providing collateral and having margin calls and whatnot. Today, it's a paper-driven, slower process that tends to be siloed within prime brokerage relationships and central clearing platforms. But in a blockchain based world where you can instantly meet margin calls and instantly move assets across the globe to meet margin calls in other jurisdictions and use the same collateral for various different time zones, being able to have access to leverage like intraday, to just be able to improve the efficiency of everything, cross platform margining, stuff like that. Blockchains really open up the space. And again, all of this just translates into an increase in the velocity of money, which generally considered a good thing in finance because that's helps you improve the return ratio.
One of the reasons that I find you to be such a credible guy in this space and great partner in the work that we've done before is because, kind of to your opening lines, your background in market structure, your almost childish curiosity and excitement about the innovations in the space, and the fact that you came to this by actually using DeFi, crypto trading and DeFi. And I think DeFi is a big piece here. You've mentioned some of these examples now many times throughout the conversation, the Aaves of the world. We haven't talked about Maker, but this stuff that really, I think, gets your imagination going. And I think that's where I've maybe seen the biggest rift in many cases between the real proponents of this technology that see the value, have experienced the value, in many cases have participated in building this infrastructure in the crypto space, and the sort of TradFi perspective, which maybe focuses on distribution, i.e. selling more financial product and or reducing the cost of running financial product, but that have some sort of fundamental cynicism around this brand new crypto-based functionality that's being built. And you seem to perfectly grasp the relevance and the importance of both sides of things, and then pull those together in a way which, in my experience, progresses both sides of the equation, both the DeFi crypto side and the TradFi side. I think you actually do a tremendous service to this space and helping move everything forward.
Those are very kind words. So I really, truly appreciate that. There's a lot of conversations where I have with folks throughout the industry, and I kind of kick it off and raise my hand and I say, I'm a degen. And for those on the TradFi side who are hearing me say that the words degen, it's a moniker in the crypto space that has a very specific meaning. And it just means, listen, I have gone bridged to all of the new chains. I've tried all of the protocols, all of the various different platforms. I've played on-chain games. I spun up a MetaMask wallet for my son, and I have him playing Gods Unchained, and he loves it. I've experienced all of this technology firsthand, and that's where my education has come from. I just had a conversation yesterday with a woman in the office who wanted to learn more. And she kept asking me the same question that I get asked repeatedly over and over again from so many people who say to me, "Give me the book. Can you please give me the book that tells me how to do all of this? What is the book that I can read?" And my response to them is, if you never touched a cell phone, I can give you a book that would explain to you what your smartphone is, but that's really not going to help you. Oh, it's a phone, but it's also a music player, but it's also a television, but it's also a camera, but it's also allows you to surf the internet, and it's a computer. Like, you have to actually physically touch the phone, see how all of it comes together, and see how the applications work, and how user friendly it is. You have to get your hands dirty. You're just not going to understand this technology until you get your hands dirty. When you go down the book route, and when you're just listening to explanations and stuff like that, time and time again, I see people get bogged down into what I call, again, analogously, trying to learn about email by trying to understand how data in the email is encrypted, sent over the TCP/IP, HTTP protocol, traverses across the internet, ends up from one. You don't need to know all of that. Like, that's not what you want to know is that you can pull up a little page and you can type an email out, and hey, you could drop some pictures of your kids in, and you can put your grandma's address in there, and you can send an email off to grandma, and she's going to receive it, and she's going to see the pictures. And the same thing with this technology. Like, don't focus as much on how it works. Like, focus on what you can do with it. And the only way you're going to know what you can do with it is if you actually touch the technology and get your hands dirty. And I always tell people, like, I am happy to just walk you through.
Of all the things that you've seen, of all the things you have insight to, of all the projects you're working on, what are you most excited about in this space right now?
I'll throw a few other things out there, harkening back to the proof of concept work that we did with City and Wisdom Tree and DTCC. What we were able to simulate was that end client holder of the fund units in token form, being able to pledge them into a facility as collateral and taking a collateralized loan off of them. And I think that that is something that has the potential to be really impactful for the industry. So if you're talking about a private asset, a private fund. Today, most of them are drawdown funds. There's a 7 to 10 year lockup period. It's anywhere from mid six to low seven figure initial investment, and you basically have no access to your money. That locks out a vast swath of the world from being able to access these assets. The people who can access them are ultra high net worth investors. For decades, what ultra high net worth investors have been doing to maintain and grow their wealth is they generally don't sell their assets. If they have to meet a liquidity obligation, to you and me, that could be college tuition for a kid. If they have to meet some sort of liquidity obligation, they don't take an asset and sell it, take the tax hit on it, and lose the upside on it. Instead, they take that asset, they pledge it as collateral, they take a borrow off of it through their private banking relationship, which is something that they have access to, and take a low interest loan off of it, use that to meet the liquidity obligation, not take a tax hit, and maintain the upside in their assets. And then as their assets continue to go higher, you can pay the loan off over time. You always have the collateral to be able to meet the obligation. This technology allows us to potentially democratize that access to a much broader swath of clientele. And again, in that proof of concept that we did with Citi, it's all published online. Wisdom Tree, DTCC spun up the collateralized borrow and loan facility. For your crypto native users, it looked a lot like an Aave. So it's sort of the same thing. That is liquidity. That is a way to take an illiquid asset class and give the capability, obviously with a haircut, give the capability for people to receive liquidity. That's an end value proposition to clients downstream that I think will help bring them on chain.
Wow. One of those final lines right there, DTCC spinning up a collateralized borrow lend facility that looked a lot like Aave, kind of sums up the whole conversation. Mark, thank you so much for making the time. Really, really fascinating. Always love getting your perspective.
Really appreciate it, Will. This was a great conversation, and I'm really excited about the future.
Mark Garabedian, thank you very much for joining us today. Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.